So let's take a look at the prices. So we obviously not only want to give you descriptive statistics, but we have taken a deeper dive in how do these prices look, what drives them, and then later on, how could they project into the future. I'll just quickly take your focus onto the picture on the right. Prices are in US dollars. And what we see is across methodologies, price distribution, prices are very, very different. These are box and whisker diagrams. Don't remember if you remember high school math. The box is the 25 to the 75 percentile. The line is the median, so the most occurring data point. And then the upper and lower ends are really the highest and the lowest points that we see. We have, as you see, not cleaned out any outliers because we don't believe that there are outliers, but have a validity in them. If you, by the way, have any questions on methodology throughout, be happy to write them in the chat. We can discuss them immediately as it becomes pressing, because I think we have better things than to ultimately discuss at the end. And so, as I said, alkalinity enhancement, widespread of prices, while we, for instance, see with BECS, where we are mostly with offtake agreements, prices have really condensed. They're somewhere around 203 to 500 US dollars, and there's not much price variation. Really, what this kind of distribution can kind of show is a little bit how far are we along with the technological development. Obviously, again, when we look at bikers, there has been a lot of sales at the same price volume, and that's why the box is just a little line. All have been sold at like 600 US dollar, and that's what we occur. And I think it's very important to really take down and acknowledge that there's massive price heterogeneity across methods. And so what really drives these prices? Obviously, one part is volumes sold. If also, maybe I can ask someone to stop me if there's an urgent question. I cannot talk and read at the same time. I'm not a good multitasker, so if there's an urgent question, just point it out to me.
Leonie, there was just a question about whether you're going to publish your data set at any point, or is it a privately acquired?
Very private. Sorry. Yeah. So volumes sold are very much important when it comes to driving prices. Overall, a 1% increase in the purchase volume decreases CDR price by around 0.02 to 0.03%. Seems very little, but if we think about we are selling in the hundred thousands, million tons, this can be considerable cost reduction. If we dig deeper into this point, we see that there is a difference between whether it's an offtake agreement or a pre-purchase agreement. So we can assume that pre-purchases occur at earlier stages of technological development, and there we sometimes see that increasing volume actually increases prices. You're constrained by the capacity you're able to pull, while when you have offtake, you usually are able to already have large-scale development, and there you can take part of economies of scale and really reduce prices further. Obviously, also a big part is the existence of a carbon price. Although it has been often lamented that, like, okay, we have an EU ETS, but CDR is not really improving despite having sort of this indirect incentive to push CDR. We do see that it does have an impact. But the impact is not always positive in a sense that you would assume, okay, having higher carbon price means we will purchase more CDR. It is the general trend, but if we dig down again with specific methodologies, we see that this differs. Some which are more competitive, I'll go into this later on with biochar, these see that if the carbon price increases, also their price increases because they're being traded more. In comparison, we also see that a high price increase in carbon actually makes other methodologies less attractive to the buyer, because they might become less urgent. Overall, if you have an offtake, you can take more advantage of these price decreases. Additionally, often from an economic perspective, we want to see how reactive are people to, and or sensitive are people to prices. And what we see with CDR credit prices, they're highly elastic in both the credit price and the carbon price, meaning that as soon as credit prices go up, demand will go down. And about carbon price, I've already said, here it can be positive and negative depending on the methodologies. But ultimately, what we do see is that the reaction is stronger to a carbon price rather than the credit price. So yes, the UK ETS, EU ETS do signal something to credit suppliers. But yeah.
There are a couple of questions in the chat just to make sure that we tackle them. One says, do you have visibility of contract prices from the same project sold pre and post FID are similar, or is there an upside for sellers in post FID contracts?
With FID, you mean these are?
I will wait for Marianne to share. But meanwhile, there's another question. Are the prices weighted by volume?
No, these prices are tons per tons, dollars per tons of CO2. So
dollars per tons. FID is final investment decision.
No, I don't. We only have, so ultimately the, I guess, post price is, there are some data points, but I don't think we can draw a story out of this, where we see a pre-purchase agreement and then an offtake agreement, which I think at least sort of captures some sort of pre and post, but these are rare points, I would say, because obviously offtakes are just generally rare. So yeah, we further then study this data because what we want to know is what happens in the future when we start to integrate them into, for example, the UK ETS, which by 2029, that's a pressing issue. That's actually in 3 years. So how do we expect prices to continue? If we continue past trends, for the most part, what we see is that we see price decreases. But we see price decreases from very high prices. So this current and future trend will continue to be that CDR is considerably more expensive than the carbon price. So the orange line is basically a forecasted EU ETS price, and it feeds back into the blue line, which is the CDR price forecasted. And so alkalinity enhancement has like pretty solid learning potentials, price reduction potential. But when it comes to BECS, bikers, and DACs, there's very little movement and price adjustment that we see. And this is maybe a slightly different pictures that you assume you get from integrated assessment models or techno-specific models, because we now don't rely on assumptions, but we use past trends to inform ourselves. And if, as I said, this trend continues, obviously this is on a limited data set, this is how the future would look like. Yeah. But the story is very different. So I think you're seeing my chat now. If we look at some other methods, and I think this is sort of the worrying trend that it's not only downwards if we look at past trends, looking at both enhanced weathering and mineralization, but we see if trends would continue, prices would increase in the next years. Now, I think enhanced weathering mineralization here, we can take them out because the data is very much driven on the pre-purchase agreements. And as I said before, if we are sort of in a pre-purchase phase, we really have limited technological readiness. And so increasing volumes means that you then face higher expectations. What we also see is that actually we saw learnings where the pre-purchase price was lower than the offtake price. So firms have not only learned sort of, oh, we can do this now cheaper because we've improved it, but we've also learned, hey, actually, we need more money to do this. It's not as cheap as we expect. And then enhanced weathering mineralization are those that also respond positively to the EU ETS price, meaning that if the price increases in this in the ETS, their price will also increase. And this is one big story also with biochar. And we don't have, we cannot solve the issue yet, but it's worth them maybe also discussing later on. Sorry, but I think this is the old slide, I'm sorry. But when it comes to biochar, what we see is really this exponential growth. Obviously, this is a little bit based that we run a log-log regression, which means that if we plot this into prices, we have an exponential curve. So this explains part of it. But we also see that CDR is being highly reactive to growing carbon prices, which we can assume will occur in the next few years. Because I think one part of it is that biochar is the only currently traded CDR on the market, meaning that if you see credit prices increase, biochar is your only durable option that is somewhat competitive. Biokurs at the moment, and on average, is around $5. That's considerably higher. Or you can obviously buy reforestation, which might be cheaper. But obviously, many firms have already been characterized as greenwashing if they buy afforestation credits because they're not always ready. Yes, Rowan, tell me the questions.
Yeah, there are 3 questions and a statement. Someone wants to confirm the currency that the charts are using.
US dollars.
US dollar. And then what assumptions have you used as boundaries for making these projections?
I think there's no large, so these are very sort of back of the envelope forecasts. So this has to be taken into consideration. It's a limited data set. And I think there's a lot more work we need to do in making these forecasts more predictable. So right now there's not much boundaries. We let them grow on themselves, but we limit it just for the next few years at the beginning so that we don't go where it becomes highly unrealistic. Yeah.
And the follow-up to that is, did you apply any learning rate assumptions?
No. So the forecast is really only driven by what we see in the past. I guess it's sort of indirectly implemented by having pre-purchase and offtake, because I don't think you can sort of assume that it's a learning rate, but it relies on whether, having moved from pre-purchase to offtake, you have improved sort of your learning. You have learned something because you can now do it at a larger scale. But no, this model is not run on any assumptions of learning rates or something. It's really data driven at the moment. We hope to link us maybe with patent data to underpin this, but this is obviously then future work. So this is really just getting a rough draft at the moment. It's just getting a picture that this is what it could go like. And as you see, biochar is really exploding in our forecasts, and obviously this has to be this should not be taken at face value, but it should be taken that if trends currently continue, these increasing prices for biochar, there might be a problem, and maybe we should also think about more why these prices are increasing by so much when it's a technology that doesn't need to actually, or technologically speaking, there's not much reason why they should increase. They should be decreasing. There's more demand for them. Why are you still increasing? Some of it is reaction to carbon prices. Yeah, demand increasing, but still there's an ongoing question why biochar is going up in this way.
And relevant to that, actually, there's the question, and then I'll close with the statement. The question is, are there any feedstock limitation that may be driving up the prices?
No, as I said, so this is really just driven. This is not like integrated assessment models or techno-specific. This is really driven by sales data. I don't think at the moment we are at the point where feedstock limitations come in, and I also don't put feedstock limitations into the model that it allows prices to rise. This is really because in the past prices have risen. It's expected to rise in the future.
Super.
Um,
Yeah.
yeah, say the statement.
The statement. It would be interesting to know how the data changes when you pull out pre-purchases, since for some pre-purchases, the link between true cost and the price and the pre-purchase are not very strong.
Yeah, so there are differences in trends, but offtakes are the rare points in this data set. So really, this data set is also driven more by pre-purchase than by offtakes because numerically speaking, these are just more abundant into the data set. And that's why we have, for instance, intense weathering mineralization still going up because especially mineralization is only on pre-purchase data. But with that, you wanted to know about integration into the ETS and what these results mean to that. And for that, I will hand back over to Josh.
Thank you, Leonie. So yeah, I think at least the kind of narrative here probably doesn't come as that much of a surprise. We all assume that the price of CDR will exceed the price of allowance. That much has been made. That point has been made quite often in the literature and in discussions. But what we hope we've done here is to provide some more empirical underpinnings to support some of those statements. So from this, we can obviously see that CDR is not competitive with prices. That is the challenge today, but it's also the challenge going into 2030. And for some methods, it could be a challenge even beyond 2040. And for others, there may be no convergence at all. So that begs the question of, if it's not the ETS, what is the mechanism? What is the instrument that we use to scale these methods? We obviously need a broad portfolio and can't rely on just a few. So this raises the question of the use of carbon contracts for difference. They are fairly well developed now conceptually in the UK with the greenhouse gas GGR business model. And these can be used to bridge the gap as they subsidize the difference between the carbon price, if that is indeed the reference price, and the cost of removal. CCFDs, if they are used in the UK, they don't they come with a cost. That's something we've been trying to understand, what that subsidy cost might be for the UK. So based on the contracted volumes we've seen so far, we think going forward for the period 2028 to 2032, the UK might have approximately 0.74 million tonnes annually, which exceeds the target of 0.51. If we were to use this average, we think the cost to the UK Treasury would be somewhere in between 42 to 162 million pounds sterling per year, or 56 to 220 million dollars per year. And this really depends on the composition of the type of CDR methods being used. If it's DAX, obviously, if it's predominantly DAX, the figure is more towards the higher end of this range. If it's BEX, then it's towards the lower end. So it depends on the composition that is procured. For comparison purposes, the UK government has so far provided about 100 million pounds sterling for R&D. So the ongoing costs are likely to exceed the cumulative total that the UK has spent on CDR to date. From 2032, the UK has a target of 17.4 million tonnes annually. So there is a significant way to go in order to achieve that. Next slide. So in terms of what does this mean for policymakers? So we observe strong heterogeneity across the CDR methods. So policies that bundle and aren't tailored towards the specific characteristics of those methods are unlikely to scale CDR. So we need policy-specific mechanisms that recognize the different characteristics, both in terms of cost, but also storage duration, technological maturity. Continued support of CDR to reduce costs and minimize this price gap. This is absolutely essential. Support for CDR can be used to allow for economies of scale and increase or reduce the difference in cost between allowance prices and the cost of deploying these technologies. This could come in the form of other instruments such as carbon contracts for difference. This is really essential to bridge price gap, as we said, but it's also really important to ensure that there is some supply in the UK ETS. Without a carbon contracts for difference, there is unlikely to be any supply in the UK ETS because these projects will not be viable on the ETS project alone. So if we want to ensure that there is some availability of CDR going forward, we really need to start deploying the CCFD instrument in order to catalyze investment in CDR methods. One other thing we've also been thinking about is, as firms are already selling future capacity, there's a lot of uncertainty about how much available supply will be ready at the point of integration. So perhaps the UK government or other governments looking at this question could step in here and act and do their own offtake agreements. For example, they could procure future volumes, and then that is then sold into the emissions trading scheme. This can be combined with the CCFD to limit the total exposure to the Treasury. We're also thinking about, at the moment, with the greenhouse gas business model, companies can sell either in the VCM, voluntary carbon market, or the UK ETS. Now that risks leaking potential supply into the ETS to other markets. So one option could be to mandate that actually the CCFD the award of a CCFD is contingent on selling that into the ETS at some point in the future in order to guarantee that supply. And then beyond this, thinking into the future as ETSs expand to other sectors, so thinking about aviation or other sectors that are currently buying CDR that are outside of the scope of an ETS, at some point in the future, they may be covered if the sectoral expansion happens. In a world where they have purchased CDR but not used it to neutralize their own emissions, we think there's an argument to be made that these volumes of contracted CDR can be retrospectively used for compliance purposes by new covered sectors. So that kind of wraps up where we are today, and look forward to taking questions. Thank you very much.
Thanks a lot, Josh and Leonie, and really appreciated that we already had a bit of interaction and questions in the chat. So saying again, feel free to get in there, ask your questions. To buy a bit of time for you to think about that, though, a quick reaction and just commentary. I really think that Josh and Leonie's work is extremely important right now, because as we have showed in the first kind of half of this debate, everyone is excited about the ETS integration. And I think what you two have set out to is, okay, let's look at the data and what is needed. And from that, you have come up with direct policy recommendations, like key findings, recommendations, which I think matter a lot and are not so much yet in the policy debate. At least in the EU, we see only an emerging discussion on needs, let's say, for an instrument like a CCFD beyond ETS. So I was wondering, your research is extensive. Like, I can only imagine how hard it was to get the price data, how many NDAs you possibly have signed. I've read in the chat there is one more person willing to sign an NDA for the data, so maybe that link can be done. But it's extensive research, and so I was wondering, why did you think this is the kind of research we want to be doing, and what set you up on this project initially? Because I think it's so timely right now, and it's yeah, we welcome it a lot.
Yeah, thanks, Louis. So the motivation really is that the arguments for why are fairly well understood, but there seems to be a bit of a detachment from the why and the how, and that's really the question we wanted to answer, and move this from the theoretical debate of we think this is a good idea to studying this in greater detail. Can we actually determine if this is the right policy mechanism? Because at the moment it's the dominant one, and if we think it's the dominant one but it doesn't work, then we haven't really progressed things very much. So we really want to provide the evidence base for policymakers to think, if this is the route you're going to go down, this is how you do it in the most successful way. I mean, personally, I've always been quite skeptical of the role of carbon markets in this space. And I'm not coming at this as someone who doesn't like carbon markets. I really do. But I think the timing of the integration is the critical thing. And I worry that we're doing it slightly prematurely, partly because it's a helpful way of funding these technologies off the UK or EU balance sheet if the polluter pays, for example. So we're doing this through some kind of political necessity, at least is some of my short-term thinking. So I really want to try, if we're going down this route anyway, how do we make sure we're doing it in the most effective way, and what analysis and evidence can we provide to policymakers to equip them with the best tools to think about the timing of this stuff, given we see that there's a huge delta in the price of allowances and CDR. How do you do this to ensure environmental integrity? And that can mean things to do with the cap, although we're not really talking about that today. How do we think about fungibility between different types of removal types? We would talk about woodland, or Fran mentioned woodland. There's a big question about that. So yeah, it's really motivated by the need to give policymakers the practical evidence and analysis to do this efficiently.
Yeah, I think I'd also like to jump in. I think at the beginning, I think today CDR is very much a theoretical discussion, anything about integration, everything. And we see integrated assessment models that have these cost efficient approaches that then spit us out. We need this much of carbon dioxide removal because it will likely cost this much. Or we see bottom-up techno-specific ones, how costs could evolve. And to study integration, to know the effects of an integration into an ETS, we really need to pin down how much will it actually cost in the future. And I think this is why we went then first down this rabbit hole, which we have really not, we're digging ourselves deeper into it, to really send what can we learn actually from actual data. And yes, it has been a lot of work getting data. So there's hopefully more to come. I don't think you're going to get an NDA from us. This is strictly speaking very confidential, but we're very happy that people partnered with us to give this data, because we really want to understand how it can go forward, and not just integrated assessment models, which have so much influence in the policy space, but are based on so many assumptions. You've asked, what learning rates do I use? Well, that's a big discussion in these models. You have discounting questions and all these sort of things that are being assumed, which we wanted to take back and be like, okay, how could maybe data influences, and maybe this data can then also later on be used to improve integrated assessment models and the likes.
And actually, maybe it's in a similar line to something you said earlier, Josh, about market appetence for research. Someone was asking, where would you see your work going next? Do you think there is any research area that is underexplored, or that governments are particularly interested in?
Yeah, so this is the first output of hopefully a series. So we're very much focused on characterizing supply and price. The next stage is to build a model of a UK ETS and simulate what happens to UK prices once we've integrated. And hopefully there's a lot of outstanding questions for policymakers that they need to answer, particularly around the cap and what date, or what are the factors to consider when you make that switch from net cap to switch between the caps. Part of that is this huge uncertainty over supply, and without any better understanding of what supply looks like, you can't make any decision. And we don't want to set an arbitrary date. A switch date should happen by X. It should be determined by a predetermined set of factors. So we hope to give further information on the parameters needed to make a decision about the switch date. That's one thing we're very interested in. In the longer term, there is a big question, and it's probably outside the scope of our work, unfortunately, due to the time, but a lot of these questions that we're talking about are very much contingent on what happens between the UK and the EU. So none of this happens in a vacuum. What the UK decides might be totally overridden as a precondition of linking, for example, or there's perhaps some quite interesting scenarios where the UK go down one route in terms of the system design with CDR, and the EU go down another, but yet they still link, and trying to figure out how that works in practice. So I think all these kinds of options are on the table. So I think there's a big question for anyone out there interested in this about linking.
And then it could be a good question to ask Remove and Francesca and Louis from Carbon Gap if you have an answer. To help with stabilizing all of these flows, is there anything that we can do as actors of the sector to encourage transparency of data prices and such amongst the member of the ecosystem? Or perhaps there is anything we could do, but we're not able to do at the moment.
We can give it a start, but also happy for others to jump in. And I think here it's kind of two views on this topic of transparency in the CDR sector. If I compare CDR with any other industry, I think I would see crazy amounts of transparency within CDR. Like it's really exceptional how much data there already is. I think if you would go to the beverage industry, ask a bit more on their prices, you wouldn't get 70% for some things. So it's kind of normal that corporations shy away from that. But then at the same time, it directly translates to what we can do in policy making. So to Josh's statement at the end, the switch date should be determined by supply and what we know about that supply. I think prices will be crucially important. So I think what the carbon gaps, the removes can do is explain that linkage and just encourage members of the ecosystems that are in a position to fight for that transparency and get it out. But I think we need to also acknowledge that overall, compared to other industries, we already have a lot of transparency in CDR. I think what is special here is that transparency to some extent is a self-serving purpose. And so I think we need to be incentivized to continue in that direction.
And yeah, maybe a couple of things to add from our side. Completely agree with you as well. And what we like to do is also encourage the open databases that are sharing data openly. We share that always in our community, and you have a lot of those, like Carbon Gap also shares a lot of standards and research repositories when possible. There's CDR.FYI that tries to keep everything as clear as possible. And we also sometimes gets involved in policy work that also encourages that. So yeah, and I completely agree that we do see a lot of transparency and people wanting to work together and wanting to create those open resources.
Can I just come in here with a really shameless plug, which is that if you're interested in transparency related to MRV in particular, the LSE has a tool, a website called tracecdr.org, which stands for Transparent Reporting and Certification. And here we map, we have a comprehensive interactive map of all the various MRV protocols, and we link this to credit issuance. So you can see how many credits are issued against certain protocols for all methods. And we also have important information about the type of accounting approaches these protocols use, whether it's consequential, attributional, how do they deal with baselines, additionality, etc. So yeah, check it out. It's great.
Thank you.
I make a point around transparency and coming back to the kind of EU and UK policy design. I think it's quite interesting. There's two different purposes here that we would be transparent about CDR volumes for. In the UK, that's for CDR suppliers, because the UK already has certainty about its cap, and whether CDR comes in or not doesn't necessarily affect the functioning of the ETS, but it obviously affects the opportunity that's available for suppliers who want to sell into the UK ETS. Then in the EU context, we have this discussion around how can we bring in CDRs on top of the cap and use CDRs to provide breathing space that could provide some relief to industry. Whether you agree with that or not, I think there's two quite different logics, but both really relevant for policymakers to understand what CDR can actually do for the ETS and what it can do, what the sort of ETS can do for CDR.
Yeah, it's one thing we didn't really touch on, but there's no, one of the arguments is to moderate prices or reduce the price of the ETS for affected industries, but there's no prospect of that in the short term, given the prices that we've seen, unless you had maybe afforestation or other or cheaper CDR. So what CDR can do for the ETS isn't very much in the short term, I would say.
This brings me to another question I had, assuming that there aren't any outstanding questions in the chat, so please do come in if there are. But on kind of pooling demand and getting government more active in kind of front-loading demand, you mentioned kind of government offtake being an important mechanism. How can that be designed to promote this cost effectiveness as much as possible? Have you had any thoughts on that kind of how government should think about which CDRs it buys, and also how it allocates contracts for CDRs? Should that be done kind of competitively? Should that be done more kind of multi-criteria approach?
Yeah, good question. So in some senses, if the CFD also had volume support as opposed to just price support, then you could integrate some kind of cost competitive function. In a world where it's just a government procurement scheme, and given that the UK government is very preoccupied with value for money in public policy, as it should be, but sometimes at the expense of promising technologies, it's a difficult mechanism to maybe get off the ground politically, which is why we've not seen an active sort of development of this policy in the UK space. But the concern is really born out of the fact that a lot of these suppliers are tying up future supply in the VCM. And so at the point of integration, there could be very little supply. And so it's the role of the government there to maybe step in and think about how it can secure some of this. That's kind of the motivation for the policy recommendation we had, that the UK government maybe moves forward in this way. In terms of reducing the exposure to the Treasury, if they're selling it in the ETS, then their exposure is broadly the same as a CFD anyway. They're only paying the top up between the ETS price and whatever price they agree in the offtake agreement. So in that sense, it doesn't really make a huge difference between a CFD in the traditional sense now. They're just forward buying the volume as well.
Yeah, I think adding to this, yes. So the idea is really just having basically a CCFD with guaranteed delivery or not guaranteed delivery, but with a volume component to it. So that the UK ETS also knows how much can they expect to get. Obviously, there might be delivery risk, but yeah. I think in terms of technologies, we've seen the heterogeneity across technologies. So obviously technology specific stuff is very important, to not bundle them all together and be like, okay, this is the most competitive, so we compare it to you, but really at the beginning have bilateral agreements. I think this is also what the UK is planning on. And then as technologies mature, you can maybe have a technology standard and stuff like that as a baseline. And I think in terms of volumes, depending on how supply expands in the UK, I don't think there are decisions yet to be made necessarily which technologies. I think obviously a portfolio approach is always best. At the beginning, you should support all of them. And then as we start to see, okay, this one's not working out, you can focus on really those that are cost competitive, because obviously we don't want to just support everything, but yeah.
Maybe or also just what you have now said, Leonie, I think also that data point from your set in terms of, I think Brexit was making 60% plus in the portfolio composition is an important learning for policymakers. So I think also there you have highlighted that just purely price-driven systems might end up dominated by one section. So I think that's another key finding important to stress. But maybe zooming out from the CDR aspects more broadly, also looking at the ETS per se. We had, and this is another of your finding actually, which I found interesting, and we could contextualize right now. We had seen a lot of discussions on how ambitious the ETS should be in the first place. And so how do these discussions impact CDR? You have shown that the overall carbon price has both positive, negative impacts. Are you expecting something already from what we see happening over the past months in the EU, where we had discussions around what should be the ambition post 2030, leading to price collapses or something like that? Do you expect something similar on CDR, that you have a negative impact, or is that positive correlation as well quite strong?
I think it's very hard to say. So as I said, this is very technology specific. At the moment, yes, the carbon price does matter, but we also see like theoretically, it's an immature market that's not necessarily always driven by rationale. I mean, no one in their mind would spend $1,000+ on potential carbon removal. It's sort of not irrational. So I don't think it will sort of translate one-to-one into CDR, these crashes in the EU ETS. But ultimately, and I think that's more of the fact, what the carbon price signals in our data, it's a sign on how important is climate policy in society per se. And in that sense, I do think there is going to be a slight impact that maybe people won't pick it up as the sort of as the market still matures. I think it's not yet as important, but later on, I think these effects will grow, as especially if we start to link or we come closer to linking, where they are really going to be dependent on each other, and then these kind of arguments by merits will have also a massive impact on CDR.
We could pivot to another topic. Louis from Bologna asks if you have any opinion on the revision of the linear reduction factor and its impact on the post 2030 framework. They also ask if you have any guess on the actual number in terms of millions of dollars, and if it could be dynamic from 2027 to the end of the ETS.
To be honest, that's not something I've been looked at in great detail, so it's not, I won't have a very well-informed opinion on that, right?
I think ultimately, when I think in the long term, the linear reduction factor will become sort of, in a sense, it definitely has to be adjusted if we integrate CDR. In the long run, we want to have the sort of, as Edenhofer says, sort of this waste disposal system of atmospheric carbon and others. And I think ultimately then, you can just reduce, maybe even more strongly, allowances within the ETS, so increase the linear reduction factor. But ultimately, it's about the volume of allowances that are in there. And if there are CDR driven, I think the linear reduction factor actually is losing in sort of importance later on. Obviously, then the question becomes, at what point is CDR big enough that it's fully integrated, and we have such a gross cap will really only be in 2050 or before, ideally before, because we don't want to see this massive increase in prices. But other than that, I think this is very much guesswork, and obviously linear reduction factors are always political instruments, and it's hard to say from our perspective what this is going to happen.
We are about 5 minutes away from the end, so I think we have time for one last question. If someone wants to ask them orally or in the chat, feel free to. But if not, I have a question, maybe a little bit of an opening topic. Looking ahead, someone asked ahead of this meeting if CDR integration into the ETS2 was already a given.
They can start and then happily hear from the UK colleagues as well. So framing a bit, we don't just have one ETS system, but we have several of them across the pond, but even within Europe, we have, with 2028, the start of a new system, ETS2, which is covering a set of different sectors, likely at lower prices than what we have seen in ETS1, giving a bit of the different technologies and sectors covered as well. But I think also in terms of then the ambition in ETS2, I think it will be lower or less hard, and you have less typical, let's say, permanent CDR needs in ETS2. Maybe more options for emission reduction technologies and so forth. So it's a lot of building, transport sector, whereas the typical CDR linked things, aviation and so forth, are more in ETS1. But nevertheless, we have seen conversations around ETS2 and CDR as well, especially in the context of the Commission developing the CRCF, the carbon farming and carbon removal regulation, with different kind of tiered outcomes or certificates. And so within that context, it was already mentioned as well that there could be potential linkages with ETS2. But I think for now, it's a very, let's say, politically contested topic. It has been just delayed by another year. And so there is a lot of other things that plague the system than CDR. And so I wouldn't expect too much movement on that for CDR developers in the next 2 years. In Europe. I think in the UK, we have another discussion on methods covered as well. And I think we should mention quickly the woodland discussion also because we had a lot of questions to that beforehand. Not sure. So Fran, Josh, Leonie, any comments on woodland?
Yeah, happy to pick that up. Yeah, it's a really contentious one, I think. Certainly in the academic and NGO community, there's probably a coalescence around it not being an ideal outcome, which stands in slight, which is a different view to that expressed in the consultation document, where a majority of respondents supported that decision, although it doesn't say who those respondents are. Maybe there was a lot of afforestation, land-based CDR developers who responded, and if so, kudos, because you've shifted the discourse substantially. Whether it will happen or not, I think it's really hard to say. My personal take, and this is only my personal take, is that it's quite likely to happen. I think they would have ruled it out by now had they thought it was a bad idea. And the language in the consultation and the supporting documents that they published in the consultation strike you as that they're, one doth protest too much. They're putting out so much evidence. You imagine that a subsequent decision is that it's yes, and here's the reasons why. So I think they're very much preparing the ground for a yes on this, and maybe by not saying no explicitly, they're sensing what their response might be from the ecosystem. So I take the emission as a sort of a tacit yes, but let's see. One thing I would say on this is that a lot of my opposition previously was around the fact that I thought the price of these units might depress UK ETS prices. And I guess I've softened somewhat on that, looking at the modelling work from the UK government and seeing how much UK woodland costs. It's actually really quite expensive. So I'm slightly less concerned about the price depressing effects of the integration if it were to occur, but still concerned around the durability of these units and whether they are truly fungible, which I don't think they are.
Thanks a lot. Chloe, I'm heading back to you.
Yep. If everyone has waited in on that final topic, I think we can close the session here. Thank you everyone for joining and staying until the end, and for your excellent questions. We hope this format was useful to you. I'm just going to share two polls with you right now so you can give us a little bit more insights on where you're from and what you believe, what you are confident in at the moment, if you feel like answering these. But thank you to all of the speakers for this panel, and thank you for this great discussion. So we went over what is even the ETS in the UK, what it is in France, what are its implications both for policies and for the market, what we could look forward to, and we look specifically at Josh's and Leonie's work on a more forward-looking output for the ETS, hoping that it's going to yield in time price stabilization and volume that would be equal to the demand. But I believe one of the key points from this discussion is that time will tell, and we're still so early that we can't even guarantee stability in that market. But it is ultimately what we should all strive towards. And one of the responsibilities that we have is to push for more transparency so that information can circulate more freely. I hope I'm not forgetting anything. If anyone has any question for the speakers, feel free to reach out to us and we can put you in touch. And we'll put the recording, we'll make the recording available online as soon as possible. Any final word?
Yes, one more thing from the Remove side. Thank you again for the speakers. Thank you for the ongoing partnership with Carbon Gap with those webinars. Just a reminder to everyone that we run those every quarter. So if you'd like to be informed of the next one that's coming up, just follow either Carbon Gap or Remove or both of us on LinkedIn. And also a shameless plug, we do have a community, a CDR online community. We'll share more details in email after this. Feel free to join. We bring in different stakeholders there to maintain that conversation. And with that, thank you so much.